Did you know SPV mortgage rates are changing in 2024 and beyond, potentially affecting your investment decisions? Now, property investors need to consider an array of things when thinking about investing in property and refinancing their existing portfolio. One of those is the cost of debt. Now, by the end of this video, you'll know not only just how to obtain an SPV mortgage, but what product to move forward with successfully to build a successful property business. 80% of buy-to-let lending is carried out via SPVs, according to specialist lenders. Now, that is a staggering statistic. If you think back 5 years ago, no one really knew about buying properties via SPVs. It's only because the government changed how mortgage interest tax relief works. In fact, they've completely abolished it. That's led to this massive movement of people buying through limited companies, in other words, SPVs. Now, what's important for you to recognize is that out of the 40 or so SPV lenders, 2 will work with you directly. The other 38, in order to get access to their products, you have to work with a mortgage broker. Now, in order to give you the best chance of an application being successful, there's 2 sides to any application that you need to be made aware of. So the first is the directorships and shareholder side of things. So that is the lender looking at the directors, looking at the shareholders, making sure that they meet policy and asking a very simple question: are we happy to lend to them? There is a bit of a myth in the market that thinks that because the property is held in a limited company, it's got absolutely nothing to do with the underlying shareholders and directors. That's complete nonsense. It has everything to do with the directors and shareholders, because someone has to be responsible ultimately for the debt. Now, as long as you fit the policy on that side, then the second half is regarding the property. Unfortunately, we're at the mercy of the surveyors. If the surveyor confirms that the property is not suitable security for the loan, the lender will decline the application. But there's a couple of things that you can do to mitigate that happening. So one is you can look to buy properties in areas that have a high rental demand. Look for quality properties that literally day one could be lent on. If you're looking at properties that perhaps are in a bit of a poor condition, chances are the surveyor is going to state that. Chances are the lender is going to decline the application. The cost of debt is so important when considering product selection, but it's not the only consideration. So at the time of shooting this video, SPV rates can be as low as 3.8%. That might sound amazing, and it is, but not when you add a 10% product fee. So when you're looking at product selection, you've got to take into account a couple of things: your short-term and your long-term goals. So in the short term, if you're looking to buy a property, add value to it, and then recycle that value back into further properties, you probably want a short-term product. If you're buying in an area that perhaps you can't add any value to the property in, or perhaps has a low capital appreciation prospect, or in fact you're buying a property that just leads no work at all, and you're not too sure about whether the value of the property will increase significantly enough in the next 24 months, perhaps take a longer-term product. But when looking at products, you've got to take into account a couple of things. So most clients add product fees to the balance of the loan. Why would they want to pay it up front? They want to keep the cash in reserve to expand their portfolios, which makes sense. But if you're taking out a 75% product today and you're adding, say, a 2% product fee, the total debt is 77%. Now, in 2 years' time or 5 years' time, if the value of the property hasn't increased, you're going to be running at 77% or 75%, meaning that you'll have to opt for an 80% product in 2 years' time or 5 years' time. So you've got to factor in capital appreciation to your product selection. It's really, really critical. But the other thing that you need to do as well is you've got to tie your short-term plans with your long-term plans. Now, if you're looking to buy, hold the property, and then just repay the debt as quickly as you can, and you don't have an opinion on future interest rate movements, then perhaps a longer term fixed rate would be most appropriate for you. If, however, you're looking to add value, you're looking to expand the portfolio aggressively, you're in a position to save lots of money, so you can make up any difference in shortfalls if you come to the 2-year period and the value of the property hasn't increased significantly enough for you to move forwards with another 75% deal, then perhaps a 2-year product will be most appropriate for you. Now, when it comes to the availability of 2 or 5 year products, everything relies on the lender's rental stress tests. If you're thinking of investing via an SPV and want to check your eligibility, click the link in the description below, book a call with me, we'll run through your plans, and in 30 minutes, you'll be fully pre-approved for SPV mortgages. Product selection needs to be combined with rental stress testing. Now, I mentioned earlier in the video, there's two sides to any application. There's the director and shareholder side, and then there's the property side. Now, this sits more into the property side of things. It's the rental income and the underlying interest rate which dictates how much you can borrow. So to give you an example, you can borrow more money on a 5-year deal than you can on a 2. And the reason being is on 2-year products, the lenders add the rate of interest plus 2% and then calculate how much you can borrow. So to give you an idea, let's say you're looking at a 2-year deal and a 5-year deal and both products are at 5%. On a 2-year deal, the rental stress test will be based at 7%. On a 5-year deal, it will be based at 5%, meaning that on the 5-year product, you can borrow significantly more money. Now, it's really important to take these numbers into consideration because it ties into your short and long-term plans. If you're looking to refinance within 2 years, you need a 2-year product. But is the rental income sufficient enough for you to meet the minimum requirement for the product that's fixed for 2 years? If it's not, you're going to be forced to fix for 5 years based upon the deposit that you have in place. Now, of course, if the rental stress test doesn't quite meet the 75% requirement that you need because you have a 25% deposit, you do have the opportunity to put down a larger deposit. Now, this might not fit with your long-term strategy. You might want to be keeping cash in the back pocket, obviously for further acquisitions down the road. But obviously just keep in mind, the higher the rental income, the lower the interest rate, the more you can borrow. When I set up SPV Mortgages back in 2018, we had access to around 30 lenders, give or take. Fast forward to today, it's around 40. That's a 25% jump in 5 years. Now, if you're not familiar with how financial services markets work, they work pretty slowly. And in this particular space, especially the mortgage space, they work at a snail's pace. Now, it's really, really encouraging. This year, we had a couple of new entrants. We had Metro Bank and we had Leeds Building Society. Both of those lenders are offering some phenomenal products, and their criteria are not too bad either. It's really encouraging for the space because more and more lenders are starting to notice it. Now, fast forward probably a couple of months, we might see Newcastle Building Society enter into the space, I've been told. I had a meeting with HSBC the other day. They have got their eyes on this space and they are looking to move at some point in the future. So it's not if they're going to move, it's when they're going to move. That's going to be absolutely phenomenal because if you look at how pricing works on the mortgage side, you have lenders and you have banks and building societies. Banks and building societies lend their own money, right? That's actually our money that we've given to them as depositors. They then lend that out. But from a lender's standpoint, they have to buy that money in. So they're buying it from other banks and building societies. They're buying it from high net worth individuals, financial institutions, and that sort of thing. So I think what will happen moving forwards, and it's just a prediction, I don't know if this will or won't, when bigger banks get into the space, they're going to want market share, and they're going to want that market share rapidly. They've got the systems, the processes, the teams behind them already built to take care of the volume that's needed to take over market share. So I can see moving forwards in the years to come, maybe 12, 24 months, the market being completely reshaped by big banks getting into the space, looking for a slice of the pie. And what does that mean for you and I? Well, it means that we're going to have better profits on our portfolios. Now, because there's a lack of information in regards to SPV mortgages, I decided to do a video on it. Now, if you'd like to watch that and learn more about SPV mortgages, click here. Thank you so much for watching.